Hey everyone, and welcome to This Explainer. Today, we're going to peel back all that slick marketing and reveal the true math behind your money. You know, from the everyday purchases we make all the way up to the massive assets we hold for retirement, the financial industry is just incredible at painting a very specific picture. But today, we're popping the hood and taking a real look inside.
Seriously, are you falling for these hidden financial traps? We all do it. We make these surface-level assumptions about borrowing, taxes, and investing. Like, we see a 0% interest tag and just assume, hey, free money. We see a massive home valuation and assume we get to keep all that cash when we sell. Or we see a sky-high dividend yield and think it's an absolute no-brainer. But today we've got to ask, what if that financial surface is completely deceiving us?
All right, so here's the game plan. We're diving into 3 distinct chapters of your financial life: BNPL versus credit cards, the vacation home tax trap, and finally, private credit and BDCs. Let's see how looking just a little bit closer can save you thousands.
Okay, Section 1, BNPL versus credit cards. Let's kick things off with consumer borrowing and tackle this massive marketing myth that buy now, pay later is somehow always the cheapest option in the room.
So, buy now, pay later platforms love to market themselves as the friendly, zero-cost alternative to those big, bad credit cards, right? Their marketing is super heavy on interest-free installments, no hidden charges, and accessible credit. But when we actually line them up against traditional credit cards, the reality is, well, it's a bit more complex. Hidden processing fees and super aggressive late penalties can completely ruin the party. Meanwhile, credit cards, despite their scary high APR reputation, actually offer global acceptance and cash rewards that BNPL literally just can't match.
Let's just run the actual math on this. Take a typical benchmark, say a purchase of 42,000 rupees, which is roughly $500. If you pay that off on time and in full within the billing cycle on a credit card, your cost is exactly 42,000 rupees. Zero interest, zero processing fees, period. But with BNPL, a lot of these platforms quietly charge a flat processing fee, sometimes up to 3% of the transaction. So at a 2% midpoint, BNPL just snuck in an 840 rupee fee onto your supposedly free installment plan.
But here is the absolutely crucial point. What happens when things go wrong, specifically late fees? The fee structure for BNPL operates regressively. That basically means smaller purchases get hit with disproportionately higher effective interest rates. So if you make a smaller purchase and hit the maximum late fees on a 10-payment plan, like with Hum for example, the effective annual interest rate from those penalties can hit a staggering 177.44%. I mean, that completely dwarfs the average credit card APR, which usually hovers around 21.5%.
And it gets worse, because the frictionless ease of BNPL leads straight into a highly dangerous behavioral trap: loan stacking. Get this, around 63% of BNPL borrowers hold more than one active loan, and they originate an average of 9 to 10 loans a year. Every single purchase triggers a separate repayment schedule. It is incredibly hard to keep track of. But the most shocking stat here, 42% of users actually attach their BNPL payments to their credit cards. It creates this vicious interest-on-interest cycle, where people are financing a BNPL purchase at credit card rates while still facing BNPL late fees if a payment fails.
Ultimately, the absolute worst-case scenario for your financial health is mixing both of these methods and carrying a balance. Doing that triggers late fees, stacked overlapping loans, and daily compounding interest that just completely destroys any advertised savings from either option. It's a total trap.
All right, moving on to Section 2, the vacation home tax trap. Let's fast forward a bit to retirement planning and see how just assuming you can sell a vacation home tax-free is, well, a devastatingly expensive mistake. So picture this. Imagine retiring at 60. You've got a comfortable nest egg and a totally paid-off Lake Tahoe cabin that you bought years ago for $385,000. Today, it's worth $830,000. Your plan is simple. Sell the cabin, downsize, and use the cash to bridge the gap until Social Security kicks in. Sounds like a really clean finish line, right? Well, brace yourself. Because of a simple misunderstanding of the tax code, you could get hit with an unexpected $95,700 combined tax bill when you finally go to sell it.
Yeah, that massive tax bill happens because of what we call the IRS exemption myth. We see this scenario pop up constantly on personal finance forums. A lot of retirees just naturally assume that the standard $250,000 capital gains exclusion, or $500K for a married couple, automatically applies to literally any property they own. But the harsh reality is that a weekend cabin almost never qualifies for this protection. The IRS just isn't quite that generous. It all boils down to the actual strict IRS rules. Under Publication 523, the Section 121 exclusion explicitly requires you to own and use the property as your primary residence for 2 of the past 5 years. If it's just a vacation home, you are paying that capital gains tax. But here's the secret. If you strategically convert that vacation cabin into your primary residence for 2 full years before selling, a married couple could potentially exclude up to $500,000 in capital gains. You could literally wipe out that entire $95,000 tax liability. It is all about knowing the actual rules beneath the surface.
Okay, bringing us to Section 3, Private Credit and BDCs. For our final chapter, let's explore how to make your money work harder by looking way past surface-level yields in the investing world. We are stepping into the realm of private credit.
So traditional banks have pretty much abandoned the cash flow lending market for middle-market private companies. Why? Usually because of company size, high leverage levels, and super strict banking regulations. And that retreat created a massive void. Enter the Business Development Company, or BDC. These are specialized lenders that step right in to provide high-yield private loans to growing companies. And honestly, the best part? By law, BDCs have to pass 90% of their taxable income directly to shareholders. That makes them an absolute magnet for income-seeking investors.
But you're probably wondering, aren't these loans way too risky? Well, when we actually dig into the historical data, a really fascinating point emerges. If we compare U.S. first-lien loans, which are essentially the bread and butter of a BDC portfolio, against traditional high-yield bonds, the data shows that those first-lien loans actually have lower historical default rates than standard non-investment grade bonds. Kind of surprising, right?
And it gets better. When defaults actually do happen, the recovery rates for these first lien loans are significantly higher. They often hover right between 60 and 80%. Compare that to traditional high-yield bonds, which frequently drop way down to the 30 or 40% range. So this unique combination of higher yields, lower historical defaults, and much higher recovery rates, it presents an incredibly attractive risk-reward profile for lenders.
Naturally, because of these attractive profiles and those massive dividend distributions, retail investors just flood into the BDC market. But, human nature kicks in. People notoriously just chase the absolute highest-yielding BDC they can find on a stock screener and call it a day. So the billion-dollar question is looking only at the dividend yield really the smartest strategy for your portfolio?
Well, the performance data clearly shows the danger of that exact assumption. If you track the high-yield BDC cohort against the low-yield cohort, you'll see that a simple yield-chasing strategy actually underperforms over time. No way, right? But why? Because an exceptionally high yield is often a massive, glaring red flag. It frequently masks underlying business risks, deteriorating loan quality, or a dividend that is just about to be cut.
So instead of blindly chasing yield, what you really need to take away from this is the importance of incorporating deeper metrics. You absolutely have to look under the hood of the BDC. Our source research strongly indicates that relying on factors like valuation, specifically the price to earnings, or PE ratio, and quality metrics, like return on equity, or ROE, gives you massive predictive power in highlighting the actual outperforming issuers.
And the performance gap over a 10-year period proves this completely. BDCs with a high return on equity consistently and significantly outpace the ones with a low ROE. Period. By focusing on the quality of the underlying portfolio rather than just getting starry-eyed over a flashy dividend yield, active investors can dramatically enhance their total returns. It just proves, once again, that looking beneath the surface really matters.
So, to summarize our explainer today, optimizing your personal finances absolutely requires a healthy dose of skepticism towards surface-level marketing. Whether you need to calculate the true cost of those sneaky BNPL processing and late fees, or you need to structure your life to legally utilize those primary residence tax rules, or even if you're just prioritizing quality metrics like ROE over simple yield in the private credit markets, the real money is always made in the details.
The financial surface is quite literally designed to deceive you. It is built to look easy, totally free, and incredibly lucrative. But armed with these true realities, you are no longer operating in the dark. So I'll leave you with this one thought. Now that you know exactly how to look beneath the surface, what will your next financial move be? Thanks so much for joining me on this explainer, and remember, keep digging deeper.